what we asked the research team to do was to look at different streaks in zero DTE trades. And
I actually put that question in our research.
then let's take a look. Let's go, Beth. Let's take a look.
Nice. Good for them.
So the efficient market hypothesis says that information from recent market action should already be incorporated into current market prices. We believe that. Despite this, we recently observed that following losing 45 DT premium positions, short premium positions, with a long premium position could improve performance over long periods, just to mess everything up. Does this hold up when looking at some of the most efficient and liquid assets out there, like the zero DT SPX options? Let's go next slide. So we did a study, and this time we're going to 20 months of zero DT option data. We examined the 20 delta strangles, that's short strangles, at the market open, with winners closed at 25% of the initial price and losers left alone. We examined the results from 4 approaches: always selling strangles, okay? Always buying strangles.
Okay.
Following a winning short strangle with another one, but following a losing short with a long strangle. So we called that.
You're flipping the cards.
No.
Oh.
We're calling that what worked yesterday.
Oh, okay. All right. That's fair enough.
Whatever worked yesterday, you do the next
it again
day.
today. Okay.
And then the opposite is reversing that, just being contrarian.
Okay.
So
I bet there's going to be some big swings in this. I haven't seen it.
Let's just go through these one more time so everybody knows what we're looking at.
This is fun.
Oh, no, Beth, go back.
Oh, Beth, you ruined everything.
Now you just ruined all. It's like
everything.
You showed us what cup the ball was under. Always selling
Where's
strangles.
John when you need him? Go ahead.
Always selling strangles. Always buying strangles. Following, we're calling this what worked yesterday. Following short strangles, winning short strangles with another one, or following losing short strangles with a long strangle. So flipping it over, or reversing that and following winning short strangles with a long strangle and losing long strangles with a short strangle. Okay, so just the complete opposite. And then all trades, it got out. No, there are no wings on this trade. If you want to do wings, subtract a little money. Let's go next slide and see where we ended up. Okay, 20 delta short strangles. If all you did was sell strangles, 93% winners. And we haven't done the streaks yet. If all the strangles were bought, 66% winners. How could that be? The answer is because, remember, we're only taking profits at 25%.
That's true.
So you can take a 25% profit on the short strangle, and you can also make money on the long strangle, potentially. Later on the day, whatever, at 25%.
So they're doing this intraday?
These are zero DTs. These are all zero DTs.
No, but I mean, they're not flipping the cards, doing whatever happened yesterday. They're waiting till the day to close and then doing it, right, the next day. So.
No, they're closing at 25%. It's not waiting to the end of the day. It's whatever. If you close at 25%, then you just do.
Gotcha.
So the next one is what worked yesterday. It's actually just what worked. Okay. And that came out at 90%. If you did the opposite, it came out at 66%, 69%. Here's the crazy thing. Everything got paid.
I know, but I don't want to put that message out there. That's a strong message.
You know what this message is. The message is you got to manage at 25%.
That is the message.
It almost doesn't matter what you do if you manage at 25%, because short strangles, long strangles, flipping over, doing whatever worked yesterday and doing the opposite of what worked yesterday, everything worked. Crazy. That's
we
what
need to start trading more 0 days, which I've told you in the past.
Okay. Let's go to the next slide. So here now we get into a little bit different. Choosing high probability trades means mostly seeing winners with a few losers sprinkled in. But how frequently do we get a winner every day of the week? More importantly, how often do losers follow losers? So next we're going to look at how frequently our short and long positions with managed winners accrued 1, 2, or 3 or more consecutive winning days. Okay, that's kind of a weird way to look at it, but let's.
Yeah, short and long positions with managed winners occurred 1, 2, 3. Or
yeah.
more.
How often do losers follow? How often do losers follow losers follow losers? And
So we're doing what worked yesterday, and it's another.
how often do winners follow? Because this is streaks.
Okay.
So we're going to look at these and accruing them consecutive days. Let's go to the next slide, Beth. Okay. So this slide here, because it's
What the hell am I looking at here?
okay, it's hard to look at. But the top says short strangles, right, Beth?
Yes, Tom.
Okay. And in the left hand, because I can't read it from where I'm
It says
sitting.
frequency
Left side
percentage.
says frequency, and the bottom
Consecutive
is hard.
winners.
Okay. So the left side says frequency, and the bottom axis says
Consistent winners, maybe. I can't.
consecutive
Oh,
winners.
consecutive. I couldn't see it. Thank you.
That's pretty impressive in the short strangle. You definitely take more risk. Oh, I got it. It's on my screen now. Perfect. So short strangles, the frequency, and then the consecutive winners. Yeah, that's a very interesting way to look at this. And you take more risk because you're short the strangles, and so you get this pretty impressive reward. Let's go to the next slide. Now, this one is long strangles. Very different, but it's still positive. Okay. And you can see the frequency and you can see the consecutive winners. Basically, what this is saying is that regardless of the strategy you select, as long as you manage early, because these are all managed early,
You're going to be in the fight.
you're going to be in the fight.
Yep.
Exactly.
Yep. You're going to be in the fight.
Beth, if you go to the next slide, for nearly the past 2 years, let's see if they come up with the same thing that we came up with. Zero DTE strangles traded at the market opening have been profitable for retail traders. Short strangles were more frequently profitable, with nearly 50% of 2-week periods being 10 out of 10 winners. Let's go back 2 slides for a second, Beth. These are short strangles, and you can see frequency. Let's see, where's 50%? Yeah, you can see that's kind of like right at the mid-axis, and these are like 10 out of 10 winners. You can see that. And so go back to the last slide, 7 out of 7. So for short strangles, they're more frequently profitable, with nearly 50% of the 2-week periods being 10 out of 10 winners. Long strangles, on the other hand, that's that one. Perfect. Go back to the last slide. Long strangles, on the other hand, rarely went a week without a loss, but had far gentler bad losses as measured by CVAR. So whichever side you took, as long as you're willing to capture profits rapidly, net profits were surprisingly close. That's exactly that was our same observation. As long as you're willing to capture profits. So it looks like everything falls apart if you hold everything too long.
When genius fails.
Yes.
When you think something's going to happen, it's going to reverse, it's going to do this.
When you try to squeeze everything. Yes.
Very good.